Welcome to PlotLines, where we'll use our over 30 years of experience in real estate communications to uncover the real stories behind real estate. I'm Heather Crowell.
And I'm Britni Acriveau. Dive in with us as we invite guests to break down the ever-changing landscapes of real estate together. All right, welcome back to PlotLines. Today we are joined by Nina Tschinkel, the Director of Investor Relations, Impact, and Communications at Catalyst Opportunity Fund. Nina, thanks so much for doing this with us today.
It's great to be here. Thanks so much for having me.
Awesome. All right, well, let's dive right in. Tell us a little bit about yourself, how you got into this role, and tell us more about Catalyst.
Thanks, Britni. And yeah, I'd love to. And I'll maybe start by introducing Catalyst as an organization first.
Perfect.
So Catalyst is an impact-oriented real estate investment firm, which owns over $1.3 billion worth of community-driven real estate across the U.S. And we invest in high potential but historically underserved communities. So communities that need a little bit of kind of catalytic capital, catalytic investment to start to revitalize.
Okay.
And we focus predominantly on real estate investments that address the nation's housing crisis, affordable housing crisis. So what that means is specifically investments into multifamily, affordable, and workforce housing that make quality housing more accessible to working families across the U.S. And I should say that we really focus on housing that serves households earning between 60 and 80% of the area median income, which is a segment that's often referred to as the missing middle. And it really refers to working families and individuals who earn too much to qualify for traditional housing subsidies, so kind of capital A affordable housing, but who still struggle with rising housing costs in high growth markets. And as an impact-oriented real estate investment firm, we really target measurable, meaningful impact related to these investments in housing alongside competitive, risk-adjusted financial returns. So very much so believe that, good investing isn't either or. A real estate investment can be financially rewarding as well as socially and environmentally impactful.
That's great.
So I'm a director at the firm. I run the firm's capital markets, communications, and impact, so impact strategy, measurement, and reporting. I come from a somewhat non-traditional background in that I worked in sustainable fashion for 10 years.
Oh, wow. All right.
Before getting my MBA and really falling in love with impact finance and with impact-oriented real estate, more specifically as an asset class. And I think of my work at Catalyst as really being centered around engagement, around helping kind of prospective investors really understand and engage with the concept of impact investing, and educating them around what's possible within the exciting and still nascent realm of impact-oriented real estate. And also, helping current investors really understand and better engage with their portfolio, whether that's through kind of best-in-class reporting on performance or data, or even stories about the impact that their capital has on actual people, so on the residents living in our buildings, or on the communities surrounding our buildings. And so it's a really dynamic role within an already really rich and meaningful landscape of impact.
Wow. Awesome. That's fascinating. Yeah. Great. So let's dig in then. I think there's our podcast is all about headlines, unpacking them, understanding them, searching for what's accurate, what's maybe a little bit misguided. There's no shortage of headlines about housing affordability and the housing crisis here in the U.S. And wanted to see if you could just help us sort of understand what you're seeing, what the reality is, and just sort of how it's, being addressed, which we'll dig into a little bit, but seems like you're well situated to talk to us about what's really going on.
Yeah, absolutely. So, when the firm was started 7 or 8 years ago, the housing crisis was really a coastal problem, centered in kind of mega cities like New York and San Francisco. But over the past 5 or so years, that's really changed. And it's really become a problem that almost every city across the U.S. is grappling with. And, while the crisis itself has been kind of decades in the making, I think the trends driving that crisis have really accelerated and rapidly over the past kind of several years. And that's really created kind of perfect storm conditions And it's kind of driven by a couple of main factors. The first really being supply demand imbalance.
Yeah. Yeah.
Sure.
So Brookings estimates a 4.9 million unit shortage of available and affordable housing, and I think that's actually kind of a conservative amount.
Wow.
Yeah.
But really, there just isn't enough housing out there for demand. And on top of not having enough housing out there, we're actually losing affordable housing by the year. So between
Hmm.
2019 and 2021, 36 states lost more than 10% of their existing affordable housing stock, essentially as units were bought up by investors and those investors increased
Upgraded.
rents.
Okay.
So we
Okay.
don't have enough housing, affordable housing. The affordable housing we do have is shrinking.
Hmm.
And then on top of that, it's become increasingly difficult to build new affordable housing, to make affordable housing projects pencil, kind of especially today,
Yeah.
when we have high construction costs, high interest
Yeah.
rates,
Yeah.
high expense growth. It's really made it so that we're not able to build enough to catch up to that supply deficit.
Hmm.
I think an interesting stat there to point out is Harvard's Joint Center for Housing Study estimates that only 1 out of every 10 new housing units built in the US, only one will be priced at an affordable or workforce affordable price point. So,
Wow.
really,
Wow.
even the housing that's being built today is largely in that luxury tier and not serving kind of the vast majority of Americans
Yeah.
where they need it. Um, the second driver that I'll just quickly speak
No,
to
go ahead.
is just, rent increases have been outpacing income gains.
Right.
Mm-hmm.
And between 1985 and 2020, so over a period of about 40 years, the national median rent price rose 149%, while overall income growth was just around 35% within that
Wow.
same span. So rent is really rising about 4 times faster than income. And it's really forced many Americans to move to kind of cheaper subpar units or spend significantly more of their earnings on rent.
Right.
And then that stat really only takes us to 2020. But what we know is that there is a significant period of rent growth following the pandemic
Right.
that really only serves to compound that stat. I mean, incomes didn't rise as quickly as rents did in that same period. So really kind of astronomical growth in rents that isn't being kind of followed in the same way by incomes. And then I guess the third that I'll just quickly touch on is that, you know, high home prices and mortgage
Right. Yeah.
have been pushing home ownership out of reach for the vast majority of Americans. And, while average rents have increased, significantly over the past 5 years, the payment on a median priced home
Mm-hmm.
has climbed by 91% in
Wow.
5 years, in the past
Yeah.
5 years. And then combining, high median home prices with higher interest rates,
Yeah.
the median monthly payment on a mortgage is over $1,300 more than the average monthly apartment rent. So it's really created a two-tier crisis affecting renters and potential home buyers differently, but severely.
Yeah. Wow.
Yeah. Wow. Can you, before we move to like another topic, can you elaborate a little bit on the reduction in supply of affordable housing? Like, how is that happening?
Yeah. Yeah. So as I mentioned, 36 states lost more than 10% of their
Yeah.
existing affordable housing stock. And essentially what that means is that investors, when, these buildings come up on loan maturities,
Yeah.
Yeah.
and are either looking to refinance or sell, many investors come in and are able to buy them and do a little bit of rehab and then jack those
Okay.
rents up to
So they're
market
moving
rate.
them out of the affordable. Okay.
Category.
Yeah.
Yeah.
Okay.
Exactly. And so it's really taking buildings that were, naturally occurring affordable housing
Yeah.
and transitioning
Yeah.
them to market
Yeah. Yeah.
rate
Yeah.
and
Okay.
essentially creating displacement within communities.
Wow.
Yeah. Okay. Well, that was really informative. Also, a little discouraging,
Yeah.
right?
Yeah.
So it's a lot to unpack there. So I guess let's pivot a little bit to some of the solutions that could help address that. Walk us through sort of some of those creative approaches to trying to tackle these
Yeah.
these crises that are
Yeah.
happening.
Yeah, it's a really great question. And there's some really great, I think, and interesting approaches to touch on here.
Okay.
So, as I mentioned earlier, my work at Catalyst really is focused on housing for the missing middle.
Yeah.
So, households who earn too much to qualify for federally subsidized housing, but too little
Sure.
market rate housing. And these are essentially, the nurses, the firefighters, the
Yeah.
teachers in our schools who are really the backbone of our society, but who
That's
are
right.
increasingly are being priced out of the communities that they grew up
Yeah.
in or that they work in. And to date, there really isn't a silver bullet. There's no federal program to support or drive development of housing that serves or is affordable to this demographic, these types of
Okay.
working households.
Mm-hmm.
And so, today's market really requires creative financial tools that are capable of, especially today, navigating, cost inflation, tightening
Yeah.
credit, volatility.
Yeah.
And so there are a couple of capital strategies that we've seen and used ourselves to date. And I think, often layered together, these capital strategies are really what's required to finance new affordable housing units or preserve kind of existing affordability. And the first, or one of the most effective approaches to building new affordable or workforce housing, really centers around investing in overlooked communities with strong fundamentals. So, proximity to transit, jobs,
Sure.
public
Yeah.
infrastructure, but little institutional investment.
Mm-hmm.
And these areas often offer kind of lower land cost basis. And they're also home to local, more impact oriented developers who understand the political landscape
Mm-hmm.
and are well positioned to navigate entitlements and secure project level subsidies. And so focusing in these kind of focusing development in these areas of high opportunity, I think not only facilitates affordability and revitalization in those areas, but also really positions investors for early entry upside in
Okay.
transitioning markets. Um, the second I'll touch on is that in addition to identifying neighborhoods ripe for investment, leveraging funding from state and local governments has
Sure.
been increasingly necessary in bridging,
Yeah.
project level kind of capital stacks for
Yeah.
construction. So tools such as, local tax abatements, tax
Mhm.
rebates, HUD-backed financing,
Yeah.
discounted land, all of
Yep.
these things can be
Yep.
really critical in helping projects to pencil. And, when used in combination, we think that they can offer more flexibility and even responsiveness than relying on traditional federal programs alone.
Okay.
And in many cases, they're the difference between a project that's financially viable and one that is not.
Mm.
And then the third is that, even when housing is built and stabilized, preserving long term affordability can be tenuous.
Yeah.
And this is especially true in, growing markets where rent growth tends to outpace income growth, as I touched
Right.
on earlier.
Mm-hmm.
And so, what we've found is that blended capital structures can really help to safeguard communities from the potential negative impacts of accelerated economic growth, i.e., displacement.
Okay.
And one solution really involves pairing market rate capital with capital from mission aligned investors.
Okay.
Who opt into a potential reduction in returns in favor of long term preservation of
Yeah.
affordability.
Okay.
And so at Catalyst, if and when rent growth and income growth within a specific market are mismatched, we leverage capital from these types of affordability driven investors who, again, are willing to reduce their returns
Mm-hmm.
in favor of preserving affordability in the face of market growth. And then we translate those returns into kind of concessions, dollar for dollar, into rent reductions for residents.
Okay. Okay.
These concessions are not structured to prop up returns for other market rate investors, but
Yeah.
instead are really focused to preserve affordability and keep rents low.
Okay.
And so I think that really highlights how I think the right capital model can really
Yeah.
balance
Yeah.
investor objectives with also affordability commitments. And again,
Yeah.
I think in isolation, none of these solutions provide the
Right.
silver bullet.
Right.
But when layered thoughtfully and certainly when deployed in partnership with local actors, they offer, I think, a viable path for creating and maintaining affordability.
Yeah. So how, when you're approaching investors, that, like you said, like that are interested in preserving affordability, and maybe taking a lower,
Yeah.
a discounted return, what, like, how are you finding that pool of investors over time? Is there a lot of interest there? And is that give us some context. Is that growing? Is that shrinking population, especially in light of the supply demand imbalance where that you spoke to earlier, where maybe investors can go out and um, you know, chase that increasing rent and, maybe the higher returns. So just curious how you're finding those investors and that pool of capital, if it's if it's growing. I'd love to
Yeah.
hear that it is. So
Yeah. So we work predominantly with institutional investors, and it really is a spectrum. But for the large part, these investors are very oriented around affordability, and
okay.
some of them have regulatory requirements related to affordability, and kind of
Got it.
specifically there are banks. So banks, for example, are held to the Community Reinvestment Act, which requires
Yep.
that they invest in low income communities and really
Mhm.
support affordability. And many banks are willing to do that and to trade off a portion of their returns in favor,
Yeah.
again, of preserving affordability in the long term. Um, so we found good alignment there. And then there are other kind of capital groups, such as healthcare institutions, that are starting to invest in housing.
Okay.
They're thinking a
Hmm.
lot about the social determinants of health.
Yeah.
How do you not just
Yeah.
treat people in the emergency room, but really invest upstream in communities and
Yeah.
things like
Yeah,
housing
it's
that have
interesting.
downstream impacts on health?
Hmm.
Yeah.
Um, so healthcare has been a really interesting kind of capital base for us,
Okay.
as well as I think large family foundations. The housing crisis has gotten a lot of ink, as we kind of touched
Yeah. Yeah.
Yeah, yeah,
earlier. And I think many kind of mission aligned investment groups are really starting to integrate housing into their kind of investment mandate, impact investment mandate, and are really looking to put capital towards solutions that,
yeah,
either create new affordable housing in the face of this incredible supply deficit, and or
Yeah.
preserve affordable housing in the face of, many affordable housing projects converting to market rate in the current environment.
hmm.
Okay.
So I guess jumping off of that, on the new construction side, I know we talked about how that pipeline is still not looking super
Yeah.
strong or healthy to sort of solve things, but why is that? Like, why are there still so few units under construction, and how do you think we sort of overcome that?
Yeah. Yeah, no, it's a
Loaded question, I guess, right?
yeah. So we are certainly hitting a supply cliff.
Yeah,
Yeah.
And as a result of challenging market conditions, which have really eaten away at profitability for developers and investors alike,
Yeah.
yeah,
construction starts have dropped sharply,
yep,
and new deliveries have also slowed. And this decline, I think, really portends poorly for America's already acute housing
yeah,
affordability crisis. And it points to further escalation and really a new wave of the crisis. And I think, the reason so few units are under construction, I think, reflects a convergence of, a number of macroeconomic headwinds. Construction costs have soared.
yeah,
That started during the pandemic due to supply chain
Yeah.
disruptions that really haven't fully resolved, as well as kind of material price inflation and labor shortages.
uh-huh,
So since 2020, the stat is, I think, multifamily construction costs have increased by 42%. So a
Wow.
really sizable
Yeah.
increase
yeah,
there.
yeah,
Um, since 2020, a little something has happened also with interest rates, right? So
yeah.
the cost of debt has increased significantly, and higher interest rates has really made construction financing significantly more expensive, and it's killed the economics
Yeah.
of many projects
Sure.
that
Yeah,
penciled out in a more favorable interest rate environment. Simultaneously, there are tighter lending standards from banks who are facing
Yeah.
their own stress in their commercial real estate portfolios.
yeah,
And that's made, DSCR minimums increase and construction loans harder to secure.
uh-huh,
And then also, operating margins really have been squeezed from both sides. So
Yeah.
stagnant rent growth over the past several years, while operating expenses, particularly insurance, utilities, payroll, and property taxes,
Yeah.
have really
yeah,
surged to kind of unprecedented levels. And so that margin compression has really eroded NOI, it's depressed asset values, and it's really left
yeah,
many developers and investors kind of struggling to identify viable kind of investment strategies.
Yeah. So I think tying into that a little bit is this wall of maturities we've been hearing about, which is related obviously to the sharp increase in interest rates over the past few years. How does that impact, um, sort of the investments that Catalyst is looking at, or just the greater opportunity for impact investing?
Yeah. I love that question. So maybe first, let me unpack a little bit more about the debt maturity wall you're
Yeah.
referencing. So, over the past several years, interest rates have been elevated.
Yeah.
And
Yeah.
I think given surrounding macroeconomic conditions, which have compressed NOI, decreased property values, at
Yep.
the same time that banks are pulling back on leverage, many developers that are coming up on loan
Yeah.
maturities have been unable to refinance their loans. And so for the past several years, banks have really used an extend and pretend
Right.
strategy.
Yep.
So instead of calling a loan due when it matures, banks offer kind of short term extensions with the hope that market conditions will improve enough for
Yeah.
the borrower to eventually refinance or sell. So after a period of prolonged kind of extend and pretend, I think banks today are really facing the reality that they can't kick the can down the road any longer.
Yeah.
And so we're now facing an incredible debt maturity wall, with really coming to a head, I think, starting this year and extending over the next several years. So in 2025 alone, $1 trillion worth of
Yeah.
loans are due. And to kind of contextualize that, that's compared to an annual average of around 600 billion. So,
Yeah.
so quite an increase.
Mm-hmm.
And then, in 2026, it's 1.15 trillion. 2027, it's even higher. So really in total over the next 4 years, we're looking at $4 trillion worth of loans coming due, which is
Wow.
really just an astronomical
Yeah.
amount.
Yeah.
And within that, due to the macroeconomic kind of challenges we've been talking about, roughly a quarter of all loans outstanding, including around 400 billion in 2025 alone, they're going to need additional capital in order to meet their debt obligations and to refinance. So instead of a cash out refinance,
Yeah.
as,
Yeah.
as kind of most developers
Yeah.
expect,
Want.
they're
Yeah.
faced with a cash in refinance.
Yeah.
And unfortunately, I think, current capital solutions for plugging that financing gap are not affordability friendly. And they're going to result in essentially a vast number of affordable housing projects converting to market rate through either repositioning or foreclosure. And that's going to erode an already strained and dwindling supply of affordable housing and really exacerbate what is already an acute
Yeah.
crisis. And I should just note that this isn't about poor management or bad business decisions. It's really about kind of fundamental market dislocation.
Yeah.
Many of these properties are operationally sound, with
Yeah.
stable tenants and consistent cash flow. The problem
Yeah.
is purely financial, kind of the gap between what properties can support debt wise and what you see kind of the markets offering. And so that hopefully unpacks
Mhm.
the kind of debt maturity wall a little bit more and kind of brings me maybe to the second part of the question, which is, you know, what is the market opportunity? And, what I'll say is that we at Catalyst see a really unique and really urgent and also exciting window of opportunity for innovative, kind of impact oriented capital to address this
Yeah.
dislocation and to provide kind of alternate solutions to
Yeah.
affordable housing
Yeah.
developers and operators who are facing financing gaps due to those challenges and who are kind of racing against the clock to refinance. And, a strategy that we think is gaining traction today and kind of the capital constrained environment is preserving affordability in these over leveraged projects facing maturities through the use of impact oriented pref equity. So basically, flexible, affordability friendly preferred equity allows projects to kind of meet their debt obligations and refinance while simultaneously kind of preserving affordability for the long
Yeah.
term. And I think what's exciting about this strategy is that it's, deeply impactful. It's helping to preserve the nation's kind of affordable housing stock in a
Yeah.
moment in time when that stock is at significant risk.
Mm-hmm.
But it also presents a real opportunity for kind of alpha generation.
Right.
And
Right.
so I think for Catalyst, we're going to be doubling down and really continuing our focus on finding innovative ways to meet the moment, and to address America's affordable housing crisis in ways that, also generate, meaningful value for our investor base.
Yeah.
Yeah. Wow.
Okay.
Yes.
A lot of good,
Yeah.
good, interesting stuff here. I know you've given us a lot to think about with regards to ways to sort of solve the crisis. Is there anything, Nina, that we haven't touched on yet that you think would be worth noting?
Yeah. Well, I guess what I'll say is, America's housing crisis, it's not going to be solved by a single approach, right? It
Sure.
really
Yeah.
requires a comprehensive strategy, kind of attacking the core of the issue from multiple angles simultaneously.
Yeah.
Um, and so, I think that starts with supply. So the
Yep.
fundamental problem is that we're not building enough housing.
Yeah.
Yeah.
And so I think in order to do that, that's going to require, zoning reform at scale. It's going to
Yep.
require relooking at and streamlining the permitting process and timeline within
Sure.
kind of local communities.
Yep.
It's also going to require infrastructure investment. So building the utilities and transportation and the schools needed to
Yep.
support new housing at
Yeah.
scale.
Yeah.
And I think all of that building will require capital, which kind of brings me to the second need, as we've discussed. The housing crisis needs financial innovation just as much as we need
Yeah.
kind of raw dollars. And
Mhm.
so smarter financing, not just more money. And that means
Yeah.
things
Yeah.
like blended financing structures that combine market rate returns with patient kind of lower cost capital. That means kind of scaling up innovative debt products with built in affordability incentives and protections. And also public private partnership, that
Yeah.
leverages
Yeah.
government resources with kind of private market efficiency, and not just subsidies and partnerships at the state and local level where they exist to some extent today, but also at the federal level. We need
Yeah.
kind of federal leadership on housing supply and investment. Um, and one other thing that I'll just say is, housing affordability is also a wage problem. Uh,
Yeah. Yeah.
we
Sure.
need direct wage interventions as well. Higher minimum wages indexed to kind of local housing costs, not just federal standards. So, for example, a $15 minimum wage goes much further in Cleveland than it does in San
Sure.
Francisco, right?
Yep.
Yeah.
Yep.
Fair.
And we're going to need, I think, kind of broader economic mobility strategies too. So skilled training and apprenticeship programs that
Yeah.
provide pathways to kind of higher paying careers,
Mhm.
small business development in underserved communities to create local wealth building opportunities. There's a lot you can do in that frontier, but my point is that you really can't address the housing problem holistically without also taking a hard look at income inequality.
Yeah.
Yeah. Yeah.
That's yeah. That's it's all unfortunate. The work you guys are doing is pretty amazing in this area.
Yeah.
So I
Yeah.
mean, thank you. I guess. Um, I guess we kind of brings us to our
Yep.
wrap up, which is the opportunity to write your ideal headline or rewrite a headline. So with that, for you, Nina and Catalyst, um, what would be the ideal headline about, the, I guess, affordable housing sector in real estate?
Yeah. So I've, of course, thought quite a bit about this. And the title I'd be interested in writing and certainly reading would be, and I'll read it. So, Seizing the Moment, a rare market inflection point for alpha and affordability. And, I think for me, this headline really describes kind of a unique convergent, a kind of convergence, moment in
Yeah.
convergence,
Yeah.
where there is real opportunity for value creation, for upside, alongside really a critical call to action,
Yeah.
Yeah.
critical need to preserve the existing stock of affordable housing. So, due to those macroeconomic conditions that have brought property values kind of back down to earth and created urgent financing gaps through that debt maturity wall, fundamentally sound properties are trading at a discount due to
Yeah.
financing problems,
Yeah.
not operational issues. And so, patient, smart capital can buy into quality assets at that discount.
Mhm.
And if you do it right, you can also structure in affordability restrictions or kind of discipline that
Yeah.
preserves affordability over the long term. And, over time, the supply constraints we talked about earlier will support long term value creation, long term
Sure.
appreciation.
Yeah.
And then the very factors that define affordable housing, kind of stable, sticky tenant base, predictable cash flows, those can and will go on to generate strong kind of risk adjusted returns. And so, I think instead of waiting for kind of government intervention or the perfect plan for addressing affordability holistically and at large, I think innovative capital can step in and preserve affordability while also generating real alpha.
Yeah.
And so I think, just the one other thing is that the headline, I think, emphasizes that this convergence won't last forever and that it's really a cyclical opportunity created by dislocation, not kind of a permanent market condition. And that, I think, creates urgency to act now before the window closes and kind of traditional market dynamics return. And so essentially, I think what it's arguing is that we're at a moment where the most sophisticated investment strategy happens to also be the most socially beneficial one.
Yeah.
Which is a really unique and exciting alignment that I think, smart investors won't let pass by.
Yeah. Wow.
All right, Nina, you gave us a lot to think about, and this was super informative. We really appreciate your time today.
Thank you so much. It was great to be with you both. Thank you for having me.
Thank you. Very informative.
This podcast is a production of Gregory FCA. If you enjoyed our discussion, please subscribe wherever you listen to podcasts